Hello and welcome to Investing 101, where we'll be covering all the basics of investing for beginners. Investing can seem like a daunting task, but it's an essential part of building long-term wealth. In this video, we'll discuss everything you need to know about investing, from the different types of investments to how to get started. So, let's dive in. Section 1. What is investing? Investing is the act of putting your money into something with the expectation of making a profit. There are many different types of investments, but the most common are stocks, bonds, and real estate. When you invest, you're essentially buying a piece of something, whether it's a company, a government, or a physical property. The goal is to have your investment grow in value over time, so that you can eventually sell it for more than you paid for it. Section 2. Different types of investments. As mentioned, there are many different types of investments. Here's a breakdown of the most common types. Stocks. Stocks are shares of ownership in a company. When you buy a stock, you're buying a piece of the company. The value of the stock will go up or down based on the performance of the company. Bonds. Bonds are essentially loans. When you buy a bond, you're loaning money to a company or government, and they promise to pay you back with interest. Real estate. Real estate is property, such as a house or a commercial building. When you invest in real estate, you're buying a physical asset that can appreciate in value over time. Mutual funds. A mutual fund is a collection of different investments, such as stocks and bonds. When you buy a mutual fund, you're buying a small piece of each of the investments in the fund. Exchange-traded funds, ETFs. ETFs are similar to mutual funds, but they trade like stocks on an exchange. When you buy an ETF, you're buying a small piece of each of the investments in the fund. Section 3. How to get started with investing. Now that you know the different types of investments, you might be wondering how to get started. Here are some steps to help you get started with investing. Set your investment goals. Before you start investing, you need to figure out what your goals are. Are you investing for retirement? Are you saving for a down payment on a house? Your goals will dictate what types of investments you should make. Choose your investment accounts. There are many different types of investment accounts, such as 401ks, IRAs, and brokerage accounts. Choose the accounts that make the most sense for your goals. Determine your asset allocation. Your asset allocation is the mix of different types of investments in your portfolio. A common rule of thumb is to subtract your age from 100, and that's the percentage of your portfolio that should be in stocks. The rest should be in bonds and other investments. Research different investments. Once you know your goals and your asset allocation, you can start researching different investments. Look at the historical performance of different stocks, bonds, and other investments to get an idea of what might be a good fit for your portfolio. Invest regularly. The key to successful investing is to invest regularly, even when the market is down. This is called dollar cost averaging, and it helps you buy more shares when prices are low and fewer shares when prices are high. Keep going. Diversify your portfolio. It's important to spread your investments across different types of assets, such as stocks, bonds, real estate, and commodities. This way, if one sector performs poorly, you won't lose all your money. Diversification can also help to reduce risk and increase potential returns. Understand the risks. Every investment comes with a certain degree of risk. Some are riskier than others, but the potential rewards are also greater. Determine your investment goals. Before you start investing, it's important to determine your goals. Do you want to save for retirement, buy a house, or save for a child's education? Your investment strategy will depend on your goals, and it's important to have a clear plan in place. Assess your risk tolerance. Your risk tolerance is the level of risk you are willing to take with your investments. Some people are comfortable taking on more risk in exchange for potentially higher returns, while others prefer more conservative investments. It's important to understand your risk tolerance and invest accordingly. Start with a small amount. It's always a good idea to start small when you're first starting out with investing. You can gradually increase the amount you invest as you become more comfortable with the process. Consider a robo-advisor. If you're new to investing, a robo-advisor can be a great option. These digital platforms use algorithms to create and manage an investment portfolio for you. They typically charge lower fees than traditional financial advisors, and they can be a good option if you don't have a lot of money to invest. Do your research. It's important to do your research before you invest in any specific company or asset. Look at the company's financials, their track record, and any relevant news or events that could impact their stock price. It's also important to understand the market as a whole and any trends or factors that could impact your investments. Start with index funds. Index funds are a type of mutual fund that tracks a specific market index, such as the S&P 500. They offer a diversified portfolio of stocks and are a good option for beginners. They also typically have lower fees than actively managed funds. Stay disciplined. It's important to stay disciplined and stick to your investment plan, even when the market is volatile. Avoid making emotional decisions and stay focused on your long-term goals. Consider dollar cost averaging. Dollar cost averaging is a strategy where you invest a fixed amount of money at regular intervals, such as every month. This can help to reduce the impact of market volatility on your investments. Rebalance your portfolio regularly. Over time, the value of your investments will change, and your portfolio may become unbalanced. It's important to rebalance your portfolio regularly to ensure that it aligns with your investment goals and risk tolerance. Use tax-advantaged accounts. Tax-advantaged accounts, such as IRAs and 401ks, offer significant tax benefits for investors. They can help to reduce your tax liability and allow your investments to grow tax-free or tax-deferred. Avoid timing the market. Timing the market is a risky strategy that involves trying to buy and sell stocks at the right time to make a profit. It's difficult to predict the market, and attempting to time it can lead to poor investment decisions. Instead, focus on a long-term investment strategy and avoid trying to time the market. Diversify your portfolio. It's important to spread your investments across different types of assets, such as stocks, bonds, real estate, and commodities. This way, if one sector performs poorly, you won't lose all your money. Diversification can also help to reduce risk and increase potential returns. Understand the risks. Every investment comes with a certain degree of risk. Some are riskier than others, but the potential rewards are also greater. It's important to do your research and understand the risks associated with each investment before you invest your money. Section 3. Types of investments. There are various types of investments available for beginners to consider. Let's take a look at some of the most popular ones. 3.1 Stocks represent ownership in a company and can be bought and sold on stock exchanges. As a shareholder, you have the potential to earn a return on your investment through dividends or by selling your shares at a higher price than you bought them for. However, stocks can be volatile and carry risk, so it's important to do your research before investing. 3.2 Bonds are a type of investment where you lend money to a company or government entity in exchange for a fixed interest rate. Bonds can be less risky than stocks, but they also typically offer lower returns. They are often used as a way to diversify a portfolio and provide stability. 3.3 Mutual funds are a type of investment where a group of investors pool their money together to buy a collection of stocks, bonds, or other assets. This provides diversification and professional management, but also comes with fees and expenses. 3.4 Exchange-traded funds, ETFs. ETFs are similar to mutual funds in that they are a collection of assets, but they are traded like individual stocks on stock exchanges. They can provide diversification, low fees, and flexibility for investors. 3.5 Real estate investments can include buying rental properties, investing in real estate investment trusts, REITs, or participating in crowdfunding platforms for real estate projects. Real estate can provide passive income and potential appreciation in value, but can also carry risks such as vacancy rates and market fluctuations. Section 4. Developing an investment strategy. Now that you have an understanding of the types of investments available, it's important to develop a strategy for investing. Here are some tips to get started. 4.1 Determine your goals and risk tolerance before investing. It's important to determine your investment goals and risk tolerance. Ask yourself questions like, what am I investing for? How much risk am I willing to take? This will help you make informed decisions about which types of investments to consider. 4.2 Choose your asset allocation. Asset allocation is the process of dividing your investments among different asset classes, such as stocks, bonds, and cash. This can help reduce risk and provide diversification. Consider your goals and risk tolerance when deciding how to allocate your assets. 4.3 Consider dollar cost averaging. Dollar cost averaging is a strategy where you invest a fixed amount of money at regular intervals, such as monthly or quarterly. This can help smooth out market fluctuations and ensure that you're buying assets at different price points. 4.4 Invest in low-cost index funds. Index funds are a type of mutual fund or ETF that tracks a specific market index, such as the S&P 500. They can provide diversification, low fees, and often outperform actively managed funds. 4.5. Rebalance your portfolio as your investments grow and market conditions change. It's important to periodically rebalance your portfolio to ensure that your asset allocation stays in line with your goals and risk tolerance. Section 5. Conclusion. Investing can seem intimidating, but it doesn't have to be. By understanding the basics of investing and developing a strategy that works for you, you can begin building wealth for your future. Remember to do your research, diversify your investments, and stay disciplined in your approach. With time and patience, you can achieve your investment goals and secure a strong financial future. In conclusion, investing can be a great way to grow your wealth over time, but it's important to approach it with a clear understanding of the risks and benefits. By following these personal finance tips for beginners, you can start building a strong foundation for your investment journey. Remember to do your research, diversify your portfolio, and stay disciplined in your approach. And always keep in mind that investing is a long-term game, so don't get discouraged by short-term fluctuations in the market. With time and dedication, you can achieve your financial goals and build a more secure future for yourself and your loved ones.